Welcome back, everyone, to the Bitcoin Business Bureau. I'm your host, as always, Litecoin Leader. Today, we continue my personal theory of economic relativity, which I'm starting to remember how to say. This is part 3. I'm going to include the other 2 parts in links like this up here. First one was about valuation and pricing. Second one was about inflation. And now we're going to talk about correlation. Now, correlation is an important term because asset managers and investors and those who want to manage their risk appropriately or according to what they think is appropriate want to know how asset classes are correlated to one another. And what that means is that how do they move against other asset classes? So how does gold move against oil? How does oil move against this S&P 500? How does Bitcoin as an asset class, as cryptocurrency as an asset class, how does it match up with all these other asset classes that are out there? We're going to cover that and why would it matter so much, or maybe it doesn't, next.
Just a quick reminder that nothing in this video is considered financial advice. I am not your financial advisor. This is not financial advice. Seek out your own advice and do your own diligence, do your own research.
So an important factor for any financial analyst is the correlation between any 2 asset classes. And there's a number of reasons for that, but I'll go into them in a moment. But first, let's just talk about the correlation itself. And correlation is just the alignment between 2 things, and it's just how well they go together or opposite of one another. So this article from Forbes tells you that Bitcoin and other cryptocurrencies are basically not correlated with almost anything. They are completely contrary. And here I will scroll down to where the chart is, but I'm just going to jump to it. So here's the chart. Let me show the bigger version of it. I'm going to move myself over here for a moment. There we go. So this chart shows correlation between Bitcoin here at the top and a bunch of other asset classes. You can pretty much ignore everything else besides the top line. Now, 100 means it's 100% correlated, which means they go in lockstep. And anything correlated with itself is going to be 100. That's why on the angle you've got 100. And this is grayed out because it's the same. This square is the same as this square. This square is the same as that square, and so on. So Bitcoin is obviously very well correlated with, on this chart, crypto indexes, and not with stable coins. So that's an indication that stable coins of the US dollar, it's not a correlation at all. They don't correlate at all. So if you look at the correlations over here on these next 6 or 7 categories, you can see Bitcoin is negatively correlated, minus 11 correlation out of a scale of 1 to 100. It's got a US dollar index of 2, which means it's not correlated at all. All these things are between plus and minus 11. Gold, oil, US treasuries, bonds, US dollar, and the S&P 500. Basically, Bitcoin is not correlated to anything. And that is a good thing because they don't want... Finding something that is not correlated to another index is great for managing risk if you want to hedge or if you want to move things around. But I'll talk about the purpose of finding these factors of non-correlated assets. That's after this. But first, we're just talking about how correlated Bitcoin and cryptocurrency are to other asset classes. It is not correlated to gold or oil or the stock market. Well, wait a minute. What happened in March of 2020? Everything went down, right? The stock market went down. The economy was shut down. What happened to Bitcoin? Well, there was some shock to the system in 2020. Let me show the chart here. This is the chart of Bitcoin. From, I'd say the last, is it a 5-year chart? Yeah, it's a 5-year chart. And you can see, here's the March 2020 event. It's barely a blip. I'm going to zoom in. Okay. This is all of 2020, and I've put it in a zone. So all of 2020 traded pretty much between 6,500 and 10,000 almost all year since November, December, and I think months before. And then came this event, this shock in March. And what happened immediately afterwards? Hey, look, everybody, Bitcoin's on sale. They bought it right back up, put it right back in the channel, and it stayed there for months and then started on its run in July. And it's in this channel. Oh, actually, it jumped up at the end of July. So if we go to the other chart, here it is. You can see that channel basically between here, and then it starts to run up at the end of July, and he takes off. So what happened in March of 2020? I thought that they weren't correlated. If the stock market went down and all the other economy parts went down, why didn't cryptocurrency go up since it's negatively correlated? Is there a possibility that there was some manipulation going on? Could that have ever happened before? Well, you see this peak back in 2017 where Bitcoin was at $20,000 and was on a tear, and then it came down. A little surprising to people that that happened. Well, that's when options were introduced for Bitcoin, and there was some speculation that that could have been playing a factor. Turns out, 2 years later, they finally admitted it. That now they said the Trump administration, but really it was the CFTC. They popped the Bitcoin bubble by using, they used the market against the stuff. So I'll slide that over a little bit so you can read it better. The head of the CFTC chair, Chris Giancarlo back then, he used options to pop the bubble. Here's the quote. The CFTC, which is the Commodity Futures Trading Commission, which is the ones that introduced the options, the Treasury and the SEC all worked together with Gary Cohn to pop the bubble of Bitcoin, and it worked. So they manipulated the market. They held the price of Bitcoin down. They did it in 2017 and 2018. Do you think it's possible they did it in 2020? So the charts go back and say, look, Bitcoin, it's not correlated to the stock market. In fact, it's negatively correlated. If the stock market goes down, Bitcoin should go up, as should crypto. That's not what happened. Let's talk about correlation and what it means and why things are positively and negatively correlated and the relative implications to cryptocurrency next. So there it is. You have correlation, and if cryptocurrency is not correlated at all to anything, which is a huge plus for a number of investors. Some who want to only look at asset classes that are negatively correlated to other things. So that, why would you want to have an asset that's negatively correlated with something else? Well, as one class goes up, the other one goes down, whereas the other one goes up, the other one goes down. So what that does is that on average, if both of them are trending upwards, give or take the volatility, you're taking the volatility out because, you know, this one's high, this one's low, and then you flip it, but on average, they're both going upwards. So you're taking out your risk because let's say the S&P 500 goes up on average, which it does, between 10 and 12% a year. But that's on average. That's over like a 100-year time frame. But cryptocurrency, it will go against the S&P 500. So if the S&P 500 happens to go up, Bitcoin and cryptocurrency should go down if they're negatively correlated. What that means is that if the S&P has a bad year, Bitcoin and cryptocurrency should make up the difference. And if crypto has a bad year, the S&P 500 should make up the difference. So if you have a blend of the two, then you get the best of both worlds. You reduce your risk overall by having both asset classes represented. And overall, you're going to trend upwards more than likely because those two things will balance out. The volatility, what they call the beta, will go down because the two are merged together. Now, hedging is not for everyone. Hedging does reduce your risk, but it also minimizes your gains. So if you think you're going to like that the apex predator, the apex currency, the apex asset that's out there is Bitcoin, like Michael Saylor does, you are not going to hedge the S&P 500 because hedging is how it does minimize your risk, but it minimizes your gains too. Most of the billionaires in the world, in fact, I would say probably 90% or more, put all their money in one basket. Like they, Facebook, Amazon, the FANG people, like they were all in on one particular project. If you put all your eggs in one basket and that basket is a winner, you're going to win huge. But of course, if it falls on its face, you're going to fall on its face with it. So the question is, what is your risk tolerance? And what is your perceived risk tolerance? And we'll talk about perceived risk in a little bit. That's going to be probably another video. But if you understand the financial situation in the world and how that, that they're printing money to infinity, and eventually that this cryptocurrency that's a deflationary asset is going to absorb it, and everything that's reflecting the extra money supply, such as the S&P 500. Of course, the S&P 500 was going to go up in terms of dollars because they're making more dollars. So the dollars have to go somewhere, so more dollars will go into the S&P 500. But in a deflationary world, a deflationary asset in an inflationary world is going to absorb all that currency eventually and should go up higher. So this correlation may not play out like it has. It's what they call it's a lagging indicator. It looks backwards. It like over the last year, how well correlated were these things? How over the last 5 years, 10 years? That has nothing to do with what may happen in the future. So based on the context and the indirect evidence, it seems to be that there was manipulation that went on in 2020 in March to make cryptocurrency look much more volatile than it really was, and it actually moved with the S&P. But it did temporarily, but it came right back up, went right back in that channel, and headed on upwards, and 3 months later, and never looked back. So to summarize all of correlation, there's positives and negatives to positive and negative correlation. If you want to hedge your risk but you minimize your gains, then you look for things that are negatively correlated and invest in both, so that you average out your risk and basically trend upwards in general, or so that's the plan and the hope. But you're going to cap your gains, because you're like, if you put half of your money, this is not financial advice at all whatsoever, just keep that in mind. But if you happen to put half of your investments into this S&P 500 and half into the crypto space, and you think that when one goes up, the other one will go down, and vice versa, well, you're limiting your gains by about 50%, because you're not in all one or the other. You're not trying to time the market. You're trying to saying that S&P is going to beat crypto or vice versa. You're in both by hedging your bets. You're hedging and saying like, well, if this one goes up, the other one will go down, but on average, I'm going to gain. So that kind of like knowing that type of thing helps you if you're a risk management specialist. But if you're trying to maximize your gains, that's not necessarily the right plan. So at the end of the day, it's entirely up to you what you want to do with your risk profile. Do you want to put all your eggs in one basket and hope for the best, swing for the moon, and try to get that maximum gains? Then you probably don't want to hedge. But if you're looking for a hedge to minimize your risk, then you want negatively correlated assets, because as one goes up, the other one will go down. So that's how you look at correlations. And if you see something that's out of character, for example, precious metals backwards and frontwards. You know that whenever gold moves, silver moves. So if gold goes up 10%, you can pretty much say that silver probably went up 10% too, because they're positively correlated. And if you see that crypto is supposed to be negatively correlated with every other asset class like oil and S&P 500, stocks, bonds, whatever, and you see an event that looks like they are correlated, then that should show up as a flag to you and say, what's going on? That doesn't seem right. Is there manipulation going on? Is there something I need to look at? Is this a buying opportunity? Maybe this is something I want to look at harder. So correlation does matter. Normally you look at it for a risk management profile, but sometimes this is an indicator of much more evidence of something else. So that's correlation. So that's the third part of my theory of economic relativity. Look for the fourth installment coming up soon. And for now, I'm just going to close the drawer on the bureau, and I'll see you next time.